Goldman. First thing I want to touch on is Goldman. Goldman raises the S&P 500 target to 3,700. I need everybody in chat to write 3,700. And even though we had a bunch of concerns throughout this year, look, from going to the very beginning of the first Market Mondays, what did we talk about? 2 indexes and 2 technology stocks. And we have broken every high that was previous to that. And now Goldman, of course, kudos to all the good people at Goldman Sachs and BlackRock. They raised the target to the S&P 500. So if you are in index funds, please continue to hold. Now look at this. After the election, we moved up 7%. The Nikkei, which is Japan's index, the Nikkei 225, hit an all-time high this month. The Russell 2000 also hit a high, and the Dow is about 500 points away from breaking this all-time high and cracking past 30,000. So during the midst of maximum pessimism, when everyone is concerned, I want you guys to shut out all the noise and all the distractions that you guys face and see. Can you type in chat, shut out distractions? Because investing is not difficult. It's just tough when we do not stick to our plan month after month. And then actions that happen over a week or 2 week horizon should not change what our overall plan is. So if a second COVID shutdown occurs, which I don't think, and at being at close to all-time highs, this will provide us an opportunity. We are close. I want to say it right now. We are too high right now to buy. So we have to wait till we have a pullback, and then we can have an opportune time. But I'm begging you, between tonight and tomorrow, please don't look to just jump into the market, because I'm literally looking at the S&P 500 on my other screen, and it's at the top of the market. Please put in chat, do not buy at the high. I'm tired of seeing a lot of you guys type, hey, well, I bought here and now it's falling apart. What do I do? Let's refrain from chasing. Our job is to be smart, intelligent investors that will consistently buy at the best price. So once again, if the top of the market, let's say Dallas, 30,000, and a house is worth 30,000, I don't want to buy it at 29,999. Got to wait for it to pull back. And with the second shutdown possibly happening, and of course, like I said, us being the highs, we'll have an opportunity. So once again, do you see why I say you should not sell your stocks? Doesn't make sense. First rule, you have to hold these for a minimum of 5 years. Next year, you're going to really hear me beat the drum of holding stocks for 20 years. And I want you to write this down. And we talked about this in March and April. And of course, we saw Disney. Kudos to everybody in Stock Club that got into Disney at 100. But we're seeing Disney take off, and they're getting to areas and highs that are almost unreasonable. MGM, we're seeing some of the cruise lines take off. It's going to take 2-4 years until airlines and cruise lines are ready to boom. So not until 2023 will we be in an area where everything is going to be fine and we take off and we're towards those highs. But if you're holding Boeing, which I know my brother got out of, but if any of you holding Boeing or any of the other hotel chains, you're going to have to wait 2 more years. And after spring and vaccinations are released, fundamentals will matter a lot more. Right now, this is a trader's market. PE ratios are crazy. Current ratios are crazy for all my fundamentalists. At some point, and we're seeing it now, when the economy goes back to normal, fundamentals will matter more than ever. So companies that are producing great revenue, they have great profit, they will rise higher, and the ones that are not doing as well will slide. So be patient. I know the market is moving quickly and it's acting very erratic, but it's our job as investors to act normal and not deviate, even when the market is being erratic and irrational. So look at this. The market always leaves clues. When the market dips 50 to 70%, please take advantage of it. The best time to plan when you're going to buy off a dip is when the market is at a high like right now. So take the top 5 stocks in your holdings. And I literally want you to go to a chart and divide that number in half. That's where, if the market falls apart, that's where I want you to load the boat. That's the area in which you should look. And then I have a treat for you guys tonight that gives you another almost fail-proof indicator of to know when to buy into the market. But 50 to 70%, if you're on a tech stock, stocks can dip up to 70%. A normal market is going to dip 50. It's a key tip. Grab your notebooks, screenshot this. I want you to go through every single decade, going back to 1950, after we get off the show tonight. And I want you to write down the percentage drop that the market dipped and take the average of those decades and divide them. You'll know an exact calculation for how far you need to set your pending order for your long-term holdings. Type yes in chat if that makes sense. So I want you to go 1950 to 60, 60 to 70, 70 to 80, 80 to 90, all the way through 2020, and see how far of a dip occurs every decade. Take that number and divide it, and it'll tell you the exact percentage for the S&P 500 or any other company that you need to have in your portfolio and where to buy. So last week we talked about an explosive move on the Dow, and of course, because the futures market and the free program is going to be out tonight, I want to give you another example. So like if you have 30 contracts, and on average, for my traders, write this down. A strong move, now not the strongest, but a strong move in the Dow is 400 points, either down or up. So for those of you that are well capitalized, and of course, trading has considerable risks, be careful. But if you're able to trade 30 contracts and go for a 400 point target, that would be 60 grand. After that, what I want you to do is take half of that money, and you guys are going to hear me scream this in the program. Take half of that money and invest it long term. And then S&P 500 with 20 contracts. For my futures traders, write this target down, 80 ticks. So if we get a strong move, 80 ticks is a normal number that you can look to shoot for. And I was looking at the oil chart, and oil may be down a slow death. And with all the companies going to renewable energy, we are literally watching an industry start to slowly die. Oil has not got to its all-time high of 2007, and more companies and countries are starting to lean away. So keep your eyes on, and we talked about, of course, TAN. Any clean energy is going to do a lot better in this area. Please write this down. If I don't have your attention, stop cooking, stop texting your bae, stop scrolling on Instagram. I need you to write these down. These are the three areas that if the VIX gets to, it is screaming for you to buy quality companies at scale. So let's go back, and I'll give you guys a cash up bonus if you can tell me what year the VIX hit 137, and Troy and Rashad can write the first person down who gets it. First level is 137. Because if we go on nationwide or statewide lockdown, which would be beneficial in terms of stopping the spread of the virus, but it would be damaging for the economy, we could go into a tailspin again. Not saying that we will, but we could. The worst case scenario, the oh my God, the world is ending level for me is 137. If VIX ever gets to 83, so you can set an alert for the VIX. If it ever gets to 83, you need to buy every quality company and put every dollar that you can affordably. I'm not an advisor. Consult your advisor. Consult Rashad. But this is the place where you want to buy equities. For those of you that are a fan of Templeton and you are a fan of being a catastrophic investor, 83 is the level to have your eyes on. And I don't know if it'll happen this year, next, 2025, 2027. Keep your eyes on that level. And the final level, of course, is 48. The VIX gets to 48. You want to go shopping for quality companies only, not Hertz, please, or any other companies that are not good, but 137, 83, and 48. And the economy will remain in this tumultuous cycle for a few more months until we have a combination of catalysts in place. So like a distribution of vaccine, and I'm telling you guys, please don't take that vaccine, but the distribution of vaccine, whether a lockdown or preventative measures in place for spreading the virus, we need faster government intervention, and then a reduction in cases. So these are the four things that we need for the market to feel safe. Now, of course, Pfizer announced their news today. Moderna announced their news about the effectiveness. We're getting closer, but we'll probably be March or April once we have like mass distribution of those vaccines. Sticking with the threes, write these down. These are the three areas to keep your eyes on in terms of COVID cases to know when the market is going to go up. The first area we need to drop underneath is 90,598. Level 2, 60,398. We're going to see a sharp increase from like a 2 to 5% growth. People are going to start to get calmer. Now, when we get to 35,000 cases nationally in the United States, this is when you'll see all-time highs. Some irrational exuberance will kick in. And then we're going to hit highs like we've never seen before. Because now we have a combination of new retail investors that are incredibly excited, that are happy about trading, that Dave Portnoy brought in, and stocks only go up. But then you're also going to have institutions and private equity together are going to be happy that the coast is clear and they can now put that powder that they've been sitting on for 8 or 10 years into the market. So 90,000, 60,000, and 35,099 is very key.
Yeah, are we talking daily cases or are we talking in total?
Total.
Okay.
The greatest asset in your arsenal that gives you the greatest chance of freedom is time in the market. I am begging you guys, I want you to stop jumping in and out of long-term positions. In order for any trend to be in your favor, whether it's intraday trading, short-term investing, long-term, you need time in the market. Time in the market is your friend. The longer you let those positions bake, the closer you will be able to get to freedom. So this is the Invest in Freedom formula. So the number of shares that you have times how much time you have in the market, plus the number of quality businesses owned, will equal how fast you'll be able to achieve freedom. And I define freedom as health, wealth, time, peace, and being around the people that you love and that inspire you, plus how you decide to give back. That's how I define freedom. But look at this. So if you had 13,000 shares, and let's say we got $114 in growth over the lifetime of the investment. And if you're investing for 10 years, $114, especially on the tech side, is nothing. That's conservative. You will be at 1.48 million. Type yes in chat if that's enough for you to retire today. Second scenario, 28,000 shares, $114 in growth, 3.192 million. Put 3 is enough in chat if 3 million is enough for you to retire off of, please. And for my big boys, 115,000 shares. You want safe gains, $114 in growth, that puts you at 13.1 million. For my business owners and all my people that have a bigger nest egg, type yes in chat if 115,000 shares will allow you to retire at 13.1 million. And it's a question that I want to ask everyone.
My graduates from my school being Forbes, bag drop.
Bag drop.
A mic drop, bag drop.
Bag drop.